Good morning, everyone. I'm Vince Lancy, and today we're going to talk about oil from multiple perspectives. Technically, its relationship to gold, its relationship in Middle East wars and geopolitics through the lens of history as well as current events. All right. So it's titled tentatively, Oil Gets the Gold Treatment. And you'll see that if you're a technician in a minute as well. But let's start with the markets themselves. The dollar is up 18 at 101.56. 10-year yields are 383, up 1. The S&P 500 is 56.06, up 10.1. The VIX is 1602, up 15. Gold is 2509, down almost $4 after making another new daily all-time high yesterday. Silver is 2960, up 16. That's encouraging. Copper is 419 and change, up 3+ cents. The gold-silver ratio continues its orderly march lower, which means somebody's buying gold on the dip and somebody's buying silver on the rally. All right, WTI 74.63, the star of the show today, up 21 cents. Natural gas at 220, up a penny. Crypto, Bitcoin 59,400, up 400. Ethereum 2582, up 53. Platinum, Palladium, both up. Platinum maybe pulling away from Palladium again. 943, 971, that's Palladium and then Platinum. Grains are all up, more or less 50 basis points in soybeans at 10.05 and corn 385, and wheat is essentially unchanged at 552.5. All right. Let's dance. Oil gets the gold treatment. We're going to talk about how oil gets manipulated. We're also, and this is not tinfoil hat stuff, folks. This is just reality. We're also going to talk about the relationship between gold and oil throughout history in a very easy to hopefully grasp concept, as well as the lens of my own early experience with gold and oil during the Iraqi wars 1 and 2. First, we're going to read you the news, yesterday's activity, and today's activity thus far. This is a professional institutional grade market rundown. Okay, the market snapshot. Let's call it pausing for breath. Yesterday, equity markets took a break, but the bid for Treasury stayed strong after a softer Canadian CPI print. This kept the US dollar under pressure across most of the FX spectrum. However, lower yielding currencies like the SEK, the Swiss franc, the yen had a good day, while the highest yielders did not. Notably, the Mexican peso slipped by over 1.5%, adding to Monday's underperformance. There was a clear sense of frustration on the currency side. Now, staying with the dollar, this morning there's a cautious tone coming out of Asia in the equity markets. The US dollar weakness is seen recently, US equity futures holding up, right? But there's a sense of caution about whether the moves in Asia might ripple out to wider markets. The sentiment is likely driven by the anticipation of the US Bureau of Labor Statistics releasing a preliminary estimate of the benchmark revision of the non-farm payrolls later today. Now, this is not something we used to care about, but it's something we care about more now since data hawks or data vigilantes, which is what really Zero Hedge is in this respect, have noted the constant revisions. I would say, in fairness, this, I think, payroll should be revised as they are periodically, but the fact of the matter is they keep getting revised lower. So economists at Goldman Sachs are predicting a large downward revision, well, possibly in the range of $600K to $1 million, a million jobs, I should say, or a 50 to 85K downward revision to monthly payroll growth from the April 23 to March 24. All right, staying with the dollar, because I think that's the star of the show right now with the election coming up. Beyond the shifting market backdrop, right? The recent U.S. dollar weakness is also tied to challenging expectations about the upcoming U.S. election and a reduction in Trump hedges. Now, what does that mean? Everyone's focused on Kamala's reforms, for lack of a better word. That's weakening the dollar. Bullish for gold, weaker for the dollar, should be weaker for stocks, but not yet. And unwinding of Trump hedges. So as the expectations of Trump winning decrease a little bit, people are going to take off those trades, right? Alec Phillips at Goldman Sachs updated his election monitor overnight, noting that Harris leads Trump by around 1.5 percentage points in national polling averages. I wouldn't make much of it, but the movement does matter. She is narrowly ahead in the swing state, likely to provide the winning electoral vote, which is currently Pennsylvania. Since August 1st, the odds of a Republican White House victory have dropped by 10 percentage points, and the odds of a Republican sweep have fallen by 4 percentage points. Conversely, the odds of a democratically divided government have risen the most, up by 11 percentage points, making it the most likely scenario. However, the outcome remains very uncertain. The next key focus will be the first Harris-Trump debate on September 10th. These polls right now, they're meaningless for your decisions if you have decisions to make but are not nervous about them, because events change polls overnight, right? The polls are good until they're not, right? If you're nervous, however, if you're nervous about decisions and you have something on that's concerning you, well, these things are going to unnerve you even more. And perhaps you should act on these polls. Let's say you're bullish the dollar and Kamala looking like she's going to win is more bearish on the dollar. Well, maybe you shouldn't be so bullish. Anyway, it's how the markets react to these micro events that are more important than the actual reaction, than the actual events themselves. The debate will be important, and it will show who the weakest hand is. Again, the next key focus will be September 10th. So after Jackson Hole, think September 10th. Let's get to oil. Yesterday, okay, this is going to be very extemporaneous, so bear with me. Yesterday, Zero Hedge posted a chart showing, as you can see, Brent in gold terms, and it's on a 40-year low, which goes back to the 80s. And the observation, I think, coming out of Zero Hedge is, oil's underwater. Oil is lower. Oil is too low relative to gold. You could also make the case gold is too high relative to oil. I'm not going to make that case. And here's why. Oil is getting the gold treatment. When there's concern in the Middle East, despite what you read in the headlines, when there is concern about escalation in the Middle East, the price of oil is a proxy for that concern. And because of that, it becomes a tail that can also wag the dog. The United States and the Saudis realize this very much. The Saudis are not like the rest of the OPEC crew. They don't want oil prices at infinity. They want high, sustainable oil prices, despite the arguments with Biden. That was theater. So that means that when there's unrest in the Saudis' backyard and they want the U.S. to be on call, they have conversations with the U.S. And those conversations are going on, and they go like this. Things are getting worse there. We're on top of it. Can you pump a little more oil? Sure. Why, the Saudis may ask. Doesn't help us. Well, the U.S. would say rightly, if the price of oil goes up, that will signal more unrest, and that will encourage bad actors even more. And there's a lot of merit to that. The Saudis will say, sure, we'll pump more oil to keep stability. We don't want a FOMO situation to come out. We don't want the Iranians to get too greedy and say, oh, oil's going up. Screw you, we're going to pump even less. So there is a problem there. And there's part of the deal that the U.S. has with the Saudis. Now, you may ask, what about the last year or so? The last year or so was theater. I'm not saying it wasn't real. It was real, but it was a negotiation. The Saudis wanted something out of it, and they're in the process of getting something out of it. Now, these comments that I just made, you're like, oh, that's just speculation. No, it's not. It's conjecture, and it's based on empirical evidence going back to the first Iraqi war. See, during the first Iraqi war, I was literally on the trading floor as a clerk, fetching cups of water for people that I worked for. And then we had this one screen, and the market was frozen right before the first Iraqi war started. And then George Shultz came out. I think it was Shultz came out, and he said, we're talking to the Iraqis, but regrettably, and shit hit the fan and oil spiked. And that was a disaster. The volatility unnerved stock markets, the price unnerved stock markets, right? It made other countries in the Middle East nervous about their own security and made them more likely to act out. And of course, we got everything under control by, doing whatever it is we had to do. But since then, before we would go in to quell a situation, we called the Saudis, not necessarily all of OPEC. We called the Saudis and said, we're going in. Don't believe me? On the eve of Iraqi War II, oil spiked to $29. And then the next morning, it was basically limit down. Now, why was that? Because oil spiked, and then the Saudis hit the button and printed more oil. Now, why did they do that? Because the oil price stability told Americans that the war was under control, right? Which means we didn't sell stocks. It told the rest of the Middle East that the Americans have things under control. Don't worry. No one else is shooting missiles to protect themselves. And it also bought the Saudis goodwill. Now, that's a fact. It's just going back, and the reason it's a fact for me to present it as a fact is because when that happened, I called the GSCI head trader and I said, dude, why is oil down? And he said, are you kidding me? We're not going to let oil stay up there. We let everybody have their taste, let everyone get long, and then the Saudis just pressed the button. That's the phrase he used, and knocked it back into place. And I go, well, that's what I said. Is the price of oil a sign that the oil is going to be short? And he said, well, that's what they want you to think. And the war was short, don't get me wrong, but they didn't want the marketplaces to get mixed messages. And it worked. And they've been doing it ever since. They used to do it with gold as well. Okay. Gold was also limit up. Remember, gold was limit up in 87. Stocks dropped, and then gold went limit down. And since then, they've been keeping a lid on gold during events to mute the volatility and mute the reaction, to mute the FOMO. So that all happens. It would seem, however, now that they don't really give a shit about gold. Maybe they have limited resources, and they're putting a lid on oil. Look, they've been cooking oil for a while. Look at that chart there, right? There's an expression in gold over the last decade. If you're trading gold, you're trading wedges. Well, look at the gold market. It's no longer a wedge, right? It's a rising channel. Look at the oil market. It's become a wedge. If you're trading oil, you're trading wedges. And that's just the reality of it. The oil market is under pressure. And we alluded to this yesterday when we said oil is losing bullish long-term investors because of the constant demoralization thrown at them in a sense like a Chinese water torture. Okay, staying with oil, right? PVM is a very large broker in the oil space, and they have some fundamental flows. So I'm going to read a little bit of context for them, keeping in mind what I just said about the oil market losing its bullish faith. Yesterday's turbulent price moves in the oil complex point to not only a thinned trading populace, but one that is seeing faith drain from those that have remained loyal to the bullish case. Now, I'm not saying they read our stuff. They're not. They have their heads buried in the oil market. But that's what we're saying. And you can see the date on that. The date's today. So crude futures have now lost around 5% of value in 3 trading sessions overnight, and adding more insult to injury was the API inventory data. After 7 weeks of draws in crude, last week's being countered by the EIA build, an increase of 0.3 million barrels. Ooh, I had a brain moment there. Was reported against an expectation of a 2.7 million barrel draw. Even with distillate and gasoline reducing stock by 2.2 and 1 million barrel respectively, the crude number outweighs in significance because the strength in the U.S. crude market has been without a doubt the main prop to bullish thinking and how such a lofty backwardation has endured up until now. The shortage of supply in finished products, specifically diesel is the most important here, usually has been the reason for oil to be higher. But over the last year, that has changed because you can see that in how crack spreads have behaved. Oil people understand what I'm talking about. However, this most recent run-up in crude showed a very steep backwardation in WTI and Brent itself, and that has cracked. And when backwardation cracks, wrong word. When backwardation eases or breaks in WTI and Brent, that's a bad sign for bulls, and bulls get out as opposed to products, which is really just a pause in the cause. So that's it. Oil is the new gold. It's crazy, but it's true. All right. More oil manipulation. Why did I say this? Okay. Oh, I say this whole thing here, this whole thing isn't really oil manipulation. I guess I'm just trying to make my case here. But the point is, we're seeing more and more unrest in the Middle East, failed peace processes. You know, you have one of these in 1995, and oil's $3 higher. See, there's no one piling into oil on news like this anymore. Oh, they're piling into it for $2, but not for $10. And then they're getting out. You know, just be aware of that. Next, the data. All right, Fed's July minutes FOMC meeting. There's always a potential surprise in there. I'm not going to pretend I know what that would be. There is the PVM report, and there's the market rundown script that I wrote and did for you all. I would remind you, yesterday, and this is off of our core here, there's a guy on Twitter named, well, EF Bullion, right? Eagle Forge Bullion. And that his name is Matt Riley. And he and I have collaborated writing about the BRICS, right? The M Bridge. And his background is like like an investigator, right? He's an intelligence officer, and he follows those type of paths, very engineering and mindset, as is mine, but he's a little bit more granular. And together, we've pretty much pieced together a lot of things. He has this out today. Yesterday, he and I talked about it. And basically, look, I mean, we're talking about a naval intelligence officer who also has diving experience, reading the Wall Street Journal story. And he's like, this is crazy. Although it's not impossible, it's highly unlikely. And so, you know, he wrote on it. And I said, you know, that's a good idea. Write on it, and we'll cross post it. So anyway, there's the story. It's unlocked. I encourage you all to read it. And in there, in several places, are Matt's own Substack. So after you subscribe to me, you subscribe to him. And the next thing he comes out will be on both. But eventually he's going to have a lot more material, I would think. All right, back to the markets. Yeah. As long as gold is up, as long as silver is up while gold is down, you could buy the dip in gold. As soon as silver cracks lower, for whatever reason, I don't care. Just be careful buying gold. Okay, that's it. I'm Vince, and I'll throw it up there for you a second. There's the gold-silver ratio. I want to put this up in the daily. This market is being traded. Someone right now is covering their silver and selling their gold. This is what a macro discretionary fund would do, right? They would, or I'm not kidding, a bullion bank. Say, okay, as gold comes off, they're catching it, and then they're unwinding their silver. They don't really care much about the silver in terms of price. they're letting the gold bid hit them, right? Or it's a fund, a macro discretionary fund that just basically said, you know what? I have $500 of profits in gold right now. I think silver's undervalued. I think I'll sell some gold and buy some silver. And that's how it works. I'm Vince. Have a great day.